This week kicks off earnings season, and on Tuesday after the market closes, some of the biggest banks report: JP Morgan, Goldman Sachs, Citigroup, and Wells Fargo. These earnings are always worth watching because they give us a snapshot of how the economy is really doing. Now, JP Morgan just published their guide to the markets, and it gives us a rough overview of current stock market valuations. And here's the main takeaway. The S&P 500 looks expensive. In fact, valuations haven't been this high since the dot-com bubble. That naturally leads to expectations of future returns. JP Morgan believes they won't be great, and as a value investor, that makes perfect sense. The more you pay for something, the lower your future returns are likely to be. Breaking it down by sector, JP Morgan shows forward P/E ratios relative to their 20-year averages, and nearly every sector looks expensive. The least expensive right now are energy, real estate, and healthcare. On the other end, consumer discretionary and tech are the most overvalued. If we look at company size, the same story plays out. Large caps, mid caps, and small caps are all expensive compared to their historical averages. That said, I've personally found more value in small caps this year, though it's important to note that a large portion of small cap companies remain unprofitable. On the macroeconomic side, GDP has been growing in line with expectations, but the US deficit continues to increase, and I'd argue that's one of the biggest long-term risks for the economy. Meanwhile, the dollar, which trended higher from 2028 to 2022, has been declining over the past couple of years, something worth considering if you're investing internationally. These are some other key aspects from the report. Companies are investing heavily in AI, which is clear from spending trends, and delinquencies have risen significantly across the board. Student loans, credit cards, and mortgages are all much higher today than just 5 years ago. But here's the main point I want to leave you with. The stock market is overvalued. If companies give weak outlooks this earnings season, we could see the beginning of a broader market correction, maybe even the early signs of a crash. Stock returns at today's prices will likely be poor over the next several years. And again, that's just basic value investing logic. The higher the price you pay, the lower your returns will get. The cheaper the price, the higher your returns.